Welcome back, members. I know it was very cloudy up there, and of course, I hope you guys have had a nice weather and a nice sip of coffee. And we are awaiting for the most important session, which is the accountant's report and Form 3CEB. If you had put this session probably an hour early, I think I wouldn't have seen any participants. But since this is a very critical for our season, so we thought we'll keep it till the end. And of course, we have a very eminent speaker, Mr. Pradeep A. and Ms. Sugandha Giri, to take this session. I request Chairman of Bangalore branch to escort them onto the dais. I request the Chairman to greet Mr. Pradeep with the floral bouquet. I would like to take privilege in introducing Mr. Pradeep A, who is a partner in BSR & Co, who in the team of Global Transfer Pricing Services and is based out of Bangalore. He has around 18 years of experience in tax consulting. Over the past 18 years, Pradeep has focused on international tax and transfer pricing in his area of specialization. He is a chartered accountant and holds a bachelor degree in commerce. He has previously worked with EY and PwC. He consults with the client in evaluating their transfer pricing models and provides their transfer pricing planning, compliance, negotiation, and APAs and representation of client in tax audit proceedings before various transfer pricing and other tax appellate authorities throughout India. He has experience in handling the transfer pricing and international tax issues faced by clients in industries such as IT and ITES, manufacturing, electronic and heavy engineering, automotive, real estate, and renewable energy. He is in the expert committee of the direct taxes of Madras Chamber of Commerce and Industry. He has worked with industry leaders in their effort to lobby with the government of industry issues and concerns. He has contributed to the revised guidance note on transfer pricing brought up by the ICAI. He also contributes articles to various national and international publications, frequent speaker, and is presented in various forums in India. With this brief introduction, I would like to leave you and the participants. Over to you, sir.
This is good to be seeing you all here in this forum. I think back from COVID, slowly the attendances are increasing in these forums. Initially there was always feel that we should meet and have these forums sitting physically alive. And thanks to the chairman sir and promote to kind of facilitate this. And the timing can't be more apt, I should say, because we are all now looking at filing our 3CEBs and the returns in the next month. So, from a timing, it's good to be kind of revising while the regulations has been in force for as long. We have been doing the transfer pricing audits for 3CEB as many years. But every year we see that progressively there is a lot of learning that comes as we go through the process, and especially when the revenue audits happen, where basically the selection of scrutiny happens by taking the 3CEB in the first place, because when the reference is made by the assessing officer, he first picks up the 3CEB and forwards to the transfer pricing officer. So clearly, I think as signing the 3CEB, which is a certification, a lot of things are from the guidance note, which is there, but practical judgment and professional judgment has to be used, which comes along with experience, seeing through various issues And that is what we are here today trying to share from our learnings and experiences. And how we are structuring this session is more, while it will be more practical oriented, but we want to run through the regulations, run through the certificate clause by clause, have a discussion, and get into the audit procedures process. And that's where myself and my colleague will be deep diving into some of the audit aspects as well of the international transactions and how we can go about it. Just by show of hands, how many of you signed certificates as 3CVs? Okay, so good. So, how has the experience been? You get the signed financials just before, not even a month before, and if you are the stat auditor signing it, you are perhaps comfortable. But if you are signing off on the 3CV where somebody else is the stat auditor, then it's as good as starting the audit all over with the related party ledgers and all of that. So that's quite a task. But then you're always put to test. Nothing comes well ahead of time. It's always in the last 1 month that it happens. And yeah. So what becomes important is here, what is at stake? What we are seeing is this transfer pricing and the international transaction. There is so much that you can draw from the financial statements, but there is much more beyond unless you are able to engage with the company and get into a detailed understanding of what is beyond the financials. That is when you get the essence of what could be those transactions which are not just visible from the related party schedule, and where you need to kind of get really into the ledgers and even beyond to understand some of these transactions which are not as evident from the related party schedules. So given this, it requires some level of understanding of the company, of the industry, of the business in which they are in, and you will be lucky if it's the same company which you are doing for the subsequent year, but if it's a new company, new industry, then it takes that much more while for you to get an understanding and get a hang of things. So we will get started as in, and how many from industry who are in the process of providing information? Industry members I can take, other than practicing, the rest are industry, or most of you from industry then? Or most of you are practicing chartered accountants? Practicing. All are practicing chartered accountants, okay. So that's good, because industry I think will be tied up in closing out and giving data now, perhaps they are not finding time. So that's what. So we'll keep it like this in terms of how we would want to run the. Clearly, compliances involves a lot of documentation and certification, and over the years it's been only increasing. So today we will focus on the Form 3CB. Since morning you must have had a very good session, one after the other, right from documentation, whom it applies, economic analysis, benchmarking, all of that. So clearly this is one important aspect, like what was told at the introduction, because here it is the individual professional judgment and capabilities at stake. Because if you do not get this right, and if there is a finding down the line, and even you don't know to whom the Form 3CB lands up at the time of a scrutiny, and in terms of under-reporting, misreporting, non-reporting, even I have seen instances where the transfer pricing officer calls upon and summons and kind of takes on the chartered accountant, whoever is signed on it, where there is a difference in the method that is put out in the 3CB and what is else in the documentation. So it requires alignment of various things around the transactions to be able to be rest assured that we have got things consistent. Like I have listed, like we have listed here, we have the local documentation, you have the master file, you have the country by country report. Depending upon the scale and size of operations, the companies need to comply. But then the most important thing is consistency. Transfer pricing is so much business, so much transaction oriented that apart from the being as an audit, and since the certificate becomes the first point of reference, and beyond which comes the documentation, especially the arm's length determination of the transaction. Clearly, while it is laid out as a method in the certificate and put out, but then what is beyond becomes very evident, very important to get into, which is the documentation. Being consistent in what you are reporting, so getting a flavor of all this with respect to the immediate previous year kind of gets you to come up to speed. So any company which we are taking it up as a case for coming for certification, it's good to have all these documents at least for the previous year if they have an history, because you'll have a head start in terms of knowing the background, knowing the transactions and what it is. Because as I said, given the time constraint, there's only limited time that you can get in terms of evaluation and deep diving these things. So getting further on, while we are focusing on the 3CB, specific to 92 CE, which is where it determines as to the certification is required to be filed. So with respect to any international transaction entered into between the taxpayer and his associated enterprise, either or both being non-residents, the 3CB is to be filed 1 month before the due date of filing the return, which is what has been stipulated. And it is applicable both for residents, non-residents. And as far as certification goes, you are already aware that even a single rupee transaction has to be reported, unlike a documentation which has a threshold of 1 crore. So the rigors on the certification is much more. Materiality doesn't matter. Even if it is not in the related party, if there is a transaction, it has to be reported. So that's how the section and the rule is worded. Coming to accuracy and completeness with respect to the information, expectation from the practicing accountant as to what is it expected when he's giving his opinion, whether proper records and documentations are maintained, and whether the particulars listed out are true and correct. What is the expectation from the accountant? Give the taxpayer, guide the taxpayer in identifying the associated enterprise. That itself gets quite tricky, because while there are a host of things which we'll see based on capital control ownership, that you have the relationship, you are able to identify, but the law has been extended to even rope in deemed international transactions, specified domestic transactions. So how does one go about it? And as practicing professionals certifying this, we need to ensure that we are covered. We are covered with respect to the judgment that we make, what is the kind of particular that is laid out before us. So these things become important tomorrow. If there is an issue, we need to have appropriate representations from the client, and we need to build our opinion, and we hold out the true and correct nature of the particulars based on what documentation we kind of scanned through and went into the verification and validation of that. So on this front, there are some expectations, which is getting the relationship to be identified. And reconciling, again, that's the first point. When we go for transfer pricing audits before the TPOs, they start off, you try and reconcile what is in CCB, what is RPT, what was in ledger. And given that the penalties are increasing, you are seeing that now 270A is there, that has been brought in, and already we had host of penalties right from non-filing to kind of non-furnishing. So given these things, and also there is a personal liability attached, it becomes very important to do the fact finding and get a hang on all the details, rightly so. So in terms of accuracy and correctness, so we will have a walkthrough of how we do the audits in the first place, so that if you have some of the clients where you have taken this up, then perhaps we can share our experiences, how we kind of go about this process practically. So that we do that in a while, so that if we are missing something, if we are left out, or if we are not deep there diving into some aspects, you will be able to pick up those things. And many times this certification is looked at as very rudimentary and perhaps passed off, saying that it's one more tick the box, let's kind of be done with it and move on. So documentation we will see at the time when the transfer pricing officer calls for scrutiny. Again, the CCB certification, wherein you are able to, where you hold on the most appropriate method, lot of analysis depends on what is in the documentation that you are building. And again, if companies are profitable, transactions are aggregated, only one business segment, life is simple, transactional net margin method becomes the obvious choice, so life moves on. But when there are different transactions, companies loss making, and really profit based approach is not an approach, and you land up in CUP or you land up in some other approach which is not a profit based, it requires you to go through the details cent percent. So CUP requires you to have an analysis cent percent. And what else can be leveraged? Because various data has been furnished to different authorities, whether it is customs, GST, and having a hang of getting all these things upfront, going about it in a very structured way helps. And again, as we say, while unlike in the financials, which is more true and fair, which is more comes out from a qualitative angle of prudence, substance over form, materiality, and the accounting standards. There's an approach. Here, it is accuracy, correctness, and be able to select and kind of get you to spot what is missing, and that too in a short span of time, which has to be backed with experience and some level of experience sharing, which you are able to gather from. And again, this deemed international transaction is very tricky. We will cover as we get into that clause as to who can be and who may be out, and responsibilities of an accountant. As we come towards that, again, I don't have to say you must be doing most of it as part of your stat audit signing, but clearly communicating with the previous auditor, getting a no objection certificate so that you can take up and there is no reason as to why you shouldn't, getting a letter of appointment, scope clearly laid out. These things are very prerequisite. And then, yeah, as in required to express an opinion that proper records, information are maintained. Being able to ask, I mean, while the company would furnish, but what is to be asked as information that is required, I think we'll get to that now. So we'll just see as we progress. This I did mention, I mean, what holds if there is a lapse. But I will now perhaps request Sugandha to step in and take you through what is the information requirement start point. What is it that we can start with, and then we'll walk you through as we go.
Thanks, Pradeep. So the first start point will become the audited financial statement. Now here is this question. Most of the companies have now applied for the extension. So all of you must be aware that 30th September is already over. Wherever the timelines were there for holding the AGM, they have applied for extension, and extension has been given till November and December as well. So now what do we do that? So in those cases, if you are the statutory auditor and you are actually auditing the RPT schedule, you are comfortable, go ahead and you can file the Form 3CB. If you are not the staff auditor also, because we don't have a provision of belated 3CB or a revising of 3CB, at least in the provision. So you may have to take a call how to go about it, whether on a management certified financial statement or do a full-fledged audit of the RPT schedule. But just be careful that while the online portal will allow you to revise the Form 3CB and also file belated Form 3CB, the provision of the Act do not allow that. So, and sometimes clients do mention that the penalty of 1 lakh of not filing Form 3CB is not material. But there are other consequences as well, because, for example, in case of APA, if there is a provision where your Form 3CB should have been filed on time. So we have to also factor those. So first is audited financial statement. Then we start with the RPT schedule in the financial statement, but we do not restrict ourselves to the RPT schedule. Why is that? We will cover it in clause 10. The ledger of all the related parties. When I mention all the related parties, as we're starting from the RPT schedule in financials, you will take the ledgers of those RPT or the related parties mentioned over there, but please ask the clients to provide you the complete ledger term. Because most of the time it happens that there are XYZ parties which might not be related party because of in the AS 18 or the Ind AS definition. So it's important that you ask for the complete ledger term. Intercompany agreement is very important. Most of the cases, like a purchase sale transaction, you can see that there is no intercompany agreement and it only works on a PO basis. But agreements, transactions like services, their intercompany agreement becomes important. So if the client does not have it, please ask for it why it doesn't have it. And the recommendation will be to have an intercompany agreement to the extent possible. Tax audit report is also important. While earlier the 48 transactions were covered in the SDT definition of transfer pricing, and therefore the reconciliation between the transaction reported in 48 and Form 3CB was important. But now if 48 is not there, there could be common related parties who are appearing in your Form 3CB as well as in the tax audit report. Some of the information like quantity details also might be there in the tax audit report. So we have to obtain that to check the consistency. Sample invoices. But sampling has to be in a way that we are covering not only material transactions but one-off transactions as well. And in cases where the transaction is very limited and invoices are, let's say, just 12 or 15 for the whole year, then we can check it on the totality basis as well.
So, yeah, thanks. While we still believe 31st October is the due date, and that's kind of just round the corner. There is again some bit of interpretation on that. So here you have basically 92E, which says furnish on or before the specified date. 44AB draws as to what is specified date. 1 month prior to the due date of for furnishing the return of income. 1 month prior to the due date of furnishing the return of income. Return of income you furnish by 30th November. So 1 month. What is this 1 month? For the purpose of Income Tax Act, what 1 month would be so different? So Income Tax Act, when it comes to the connotation of the period of a month, takes it from reference of the British calendar month. Okay. So British calendar month, I mean from an Oxford Dictionary reference, it comes out as is defined as a period from a particular number day in 1 month to the day with the same number in the subsequent month. So if 30th November is the due date for return filing, the British calendar month will hold 30th October to be 1 month before the due date and not 31st October. So the message here is don't take chance for 31st October. But this year, I think 30th October happens to be a Sunday, so again going back to General Clause Act, if this due date is a statutory holiday, then perhaps you may get a day. But again, we wouldn't recommend, while still the advantage is because it's portal filing, you can stretch till about midnight. But then our recommendation is not to take chance for 31st, and for the rest of the years, at least our position is like 30th October given by the General Clauses Act, and also from an Income Tax Act month refers to the British calendar month. So while this is a bit of a heads up to you as to what you should be watchful of when it means 1 month before due date of filing the return. Again, these we did speak about. When it comes to CCD with respect to foreign companies, branches, permanent establishment, there is a new variation now with respect to significant economic presence. Entities where foreign entities have revenues in India more than 2 crore and 300,000 base. They are also selling into India for their related parties, companies in India. Then how do you disclose? How do you disclose? So that's a new dimension if SEBs have to disclose. So that's the another dimension. Clearly, I think it's only getting more and more bringing into the net of compliance and reporting. First you report, then let us see what is the attribution or whether you are having a P or not. Yes, sale has happened. Any transaction for that matter, irrespective of profit, income, loss, asset, having a bearing on that, you end up reporting. So what we will do is we will go just a walkthrough of the audit procedure. Where does it start? How does one go about it? So first comes the relationship between associated enterprise. Clearly we will kind of go through it as we get into the direct holding, indirect holding based on capital control management, what are the sub-limbs. But by now things are by and far sorted, but it is not that something done and over. For even an existing company, if you are coming to the next year, you will have to do a fact finding as to what in the relationship globally kind of has changed and which has a bearing, and especially when new associated enterprise start transacting with the Indian company. So identification of the AE becomes the start point, then comes the international transaction, what is the risk cross which happens, and whether like a loan borrowed where it is repaid, you need to report the repayment. Some are tricky, I mean even to the extent of whether dividends should be reported or not. While it may appear a settled issue, but the noose gets tightened. And when the noose gets tightened, that everything has to be reported, and for non-reporting there is a penalty on what you have not reported. To be conservative, you go overboard to report with an appropriate note. So that's how it's kind of the taxpayer and the certifying accountant is being pushed to come above board and perhaps report and file more on conservatism, even if there is a case where it should not be applicable. Determining arm's length price. This is more an art plus science, whatever you can say, but at the end of the day we just go with what is available to be able to defend the position that is already landed by closing the books for the year. But again, being thoughtful about how the revenue would look at a particular method, how the transaction or the profitability with respect to the entity or the business segments would be determined. I would perhaps recommend, with all my last 2 decades of experience in the field of transfer pricing, is not to have one particular approach or one particular method, have a fallback method. go with what is best given the facts and the availability of data of the company and of the comparables and all of that, but always adopt a transaction specific approach. So for each transaction you have a level of defense with respect to methodology. Look at entity level, look at segment level, and where you have visibility, please try and get visibility on the overseas entities' profits. If overseas entity is just acting like a marketing arm trying to get more business for India, then what is left out there to be kind of making or shifting of profit? Is it at all involved? So get an all-round perspective before zeroing in on the arm's length price and the methodology around how you go and defend this arm's length price. Documentation, yes, it is pretty much defined, but when it comes to economic analysis, which is where this is generally takes a backseat because the taxpayer is not insisted to file the TP documentation along with the PCB. Only PCB is more due date bound. But a lot of mismatch happens if you go on the process of building documentation subsequently at the time when you are given only 30 days at the time of scrutiny calling for the documentation. Postmortem doesn't help because memory is only short-lived, people keep changing, data is not available. Please don't take that chance. It might be a client for a decade or it might be that you have been working on it through and through, but don't try to have that accepted in any light manner. Unless you get convinced up to a certain level, till the last day, till before you push off the CCB into the portal, do that fact finding and be convinced that you are covered all around. Because many a times some other priority comes and then it just kind of you are not able to close and the documentation report will ever remain open, and then when authorities ask you are not able to give, then how do you issue the certificate? The certificate will mention a method, other method. Now that has become a matter of convenience. Anything you ask, we put other method and move on, we will defend what is the other method that time, but may not be the right thing to do. Again, we will quickly run through as to this certification and while we touched upon earlier what it is. So para 1, clearly I'll just read out, we have examined the accounts and records of the company, name and the address in the assessee with the PAN relating to the international transactions and specified domestic transactions entered into by the assessee during the previous year. So clearly it is the examination of the accounts and records. What it is, yes, as I earlier mentioned, if you have been the statutory auditor for the company and you are issuing the form PCB, it becomes that much more easier because you would have done it for your stat audit, tax audit, and you would have also, you can kind of leverage on that. And clearly the onus is on the taxpayer to be able to maintain and present, but you can also rely on the work of the other statutory auditor if you are issuing the form certificate. Like sometimes the internal audit is done by you, you may not be able to issue from an independent standpoint and the certificate has to be issued by somebody else, or it can be vice versa. So you just kind of, how much we can leverage, again it is left to our judgment. And that's where I think getting into all the accounts and records to the extent that we want to get ourselves convinced that they are put out is where I think the information that we seek is kind of relevant as to what we want to see as proper records. And coming into as to examination, again documents prescribed and to be maintained. We after examining the records, you have to hold out whether it is proper, and you can only kind of hold out whether it's proper if you are able to deep dive and get into the details of it. And since it is certification where you have to be accurate, correctness is the emphasis here. Wherein to what level of depth that you are able to get a hang on the financials in terms of numbers, accuracy on the numbers, and doing some level of test check. So that's where getting the invoices, looking into the ledgers, all this becomes relevant. And we will now walk into each of the clauses which subsequently follows. So we'll get into the clauses.
Just going back to the report again, what Pradeep emphasized on the documentation. A lot of times we have seen the 3 CBs where the TP documentation is not maintained. But when you are signing the 3 CBs, you are actually certifying that, in my opinion, proper information and documents as are prescribed. Prescribed is the rule 10 documentation. So it is, if it is not in that format of a TP study, at least all the all the line items of this whole 10D have to be ticked, whether it is maintained or not, because ultimately you are certifying that. So the onus is on us and not KCC. Yeah. Going on to the part A of Form 3CB, which is very simple, just the general information which will be readily available. Here the point number 4 is important on the nature of business or activities to have a consistency between the income tax return and what is mentioned in the Form 3CB. So the business has particular clauses or the particular code, right, under which you have to categorize the assessee. So that has to be common. That has to be common between tax audit, income tax return, and Form 3CB. Point number 8 and point number 9. Aggregate value of international transaction is also important. So hold your thoughts. We will come back to this when we talk about clause number 14. Why this aggregate value of international transaction is also important. Nowadays, it's good that the portal, the software version of it actually calculates the total of it. But sometimes we have also observed some mistakes. So while we are relying on the portal's utility, please do check in Excel or calculator as well that the total value of international transactions cannot be different from what you are actually reporting in the clauses. And just going back to that aggregate value of transaction, it says aggregate value of transaction as per the books and not as per the ALP. So just be careful if there is a suo motu adjustment in any of the clause where as per the ALP amount is different and as per the books, this aggregate value of transaction is as per the books.
So 92A gets into associated enterprise, the relationship. When is an associated enterprise established? Okay, so clearly the primary association 92A1, which goes with respect to based on the capital control management, and direct and indirect holding. Put together, you will have to collectively see whether it is indirectly also held. So here it's an illustration ABC, B holds into C, A holds into B, and given that it's a direct relationship, you know that A will be an associated enterprise of C, and the next you have 5 entities. Again, it's like there is a common ultimate parent, and then ultimate, all of them fold into A. So any crisscross, again, it's creating an A relationship. So beyond the 26% shareholding, equal to or more than 26%, there are other links which determines the relationship, which is again based on the capital which is holding or management, control and influence. So while on the shareholding you can figure out, and again from Companies Act registers you can find out with respect to loans and other kind of relationships, board membership, there are certain aspects where the influence can be there because of significant dependence from a business angle. So where there is a, say, 100% dependence on the intangibles, perhaps relating to the brand or relating to the technology, entirely taken from one entity by the other entity, then it's a clear relationship of associated enterprise. And again, where you supply more than 90% of your output back to the another enterprise. So there are various sublims which creates this influence, which creates this relationship, which you have to be guarded and examined. It may not be upfront available anywhere, but then again it is more of fact finding. But clearly, one entity being an Indian company, the other entity being the overseas, and it is a resident to non-resident, you will have to look at based on these relationships. Resident to resident perhaps may not directly, having a direct shareholding resident to resident domestic companies perhaps can be kept out. But even resident company to a third party, where the resident company has a AE relationship through a deemed international transaction, there can be a AE relationship, deemed international transaction where even resident to resident can be a international transaction. So going into the aspect of when do we call them out as associated enterprise? So one entity comes into the fold of relationship during the part of the year. So how do we go about disclosing? So do we disclose the transaction for the entire year, or kind of you disclose it since the relationship starts off? Like one of the overseas supplier who is supplying materials to us, suddenly our group acquires him, and then we continue to buy from him. So he becomes an associated enterprise. But you may decide, it may happen on October 1st, but he's already been supplying to us from April to October. We have transactions. It could be so that the terms and conditions of his arrangement that which he supplies to us is also determined by the group till then, because group had significant influence. So he is a third party for us with whom we didn't have. So the transactions for the first half might be under the deemed international, and subsequently it is become an AE, so it will come under the associated enterprise and international transaction. There could be chance for that as well. And again, deemed international transaction is a fact-finding exercise. We, in fact, that's where we seek representation from the company, and as we also scan through the ledgers, again, the more deeper we get into these transaction relations, and we will be able to fact-find. Otherwise, it always remains under the radar. But non-reporting of deemed international transaction also can result into penalties and repercussions. So.
Just
Yeah.
one point on this deemed international transaction. I think this is not working. Am I audible? See, while when you do the exercise of identifying the AE, you will identify the DITs, deemed international transactions as well. But the reporting of the party name of the deemed international transaction will be in clause 20. Yes, and not in clause 10. Clause 10 says that list of associated enterprise. If you read clause 20, that also says name and address of the party with whom you have entered into deemed international transaction. I'll just read out. It says name and address of the person other than the associated enterprise. So it says other than the associated enterprise. So the clause 10 will have the name of the associated enterprise. But the exercise of finding the deemed associated enterprise, you can do that when you are doing it at the clause 10 itself. So the reporting will happen in clause 20. Is that clear?
See, the objective of this deemed international transaction is there are three instances where between related parties you can have an interposing third party agent who can just be a intermediary, and the prices can get manipulated. So this is something the government wanted to curb, and it can be either a resident or a non-resident. It can be anywhere. So those are the transactions which will be looked at even by the regulators to see if there is some kind of pattern of profit shifting using them as an intermediary. So, and irrespective of they being resident or non-resident, so there is a separate clause for that where you make the listing. And again, it doesn't happen the first year the company comes forth saying that these are deemed. It evolves. So over 5-6 years, then finally, and again, that is from the revenue side, but clearly there is merit in deemed international transaction from the taxpayer or the company side, because many global contracts, there is economies of scale, there is benefit by, so like an HP or a Lenovo or someone will be there as a global player who will cater to the rest of the globe's needs plus the headquarter needs of a company. So they will have a master contract with them, expecting them to supply to the Indian company as well. So terms conditions are determined by the headquarter for the Indian company, which is the assessee here, and we don't need to negotiate because globally the group has got a good deal, and if we were to negotiate individually, it may be higher also. So there is a business angle, there is a commercial angle in the right sense, and so in both the ways, where how revenue looks at it, targeted saying is it an interposed agency to shift profits vis-a-vis the operating model in which the multinationals operate is to maximize their profits at the group level, for which if there is a committed group supplier, he does for rest of the world, there might be some angle where some may charge more, some may charge less, but overall they stand to benefit, because of which these contracts are there. But at the same time, when some of these we are reporting, like the company is reporting this in the CCB that it's a deemed international, it could be so the same officer might be the officer for the reported entity, Wipro, and he would want to see in their CCB whether they are reporting this entity, which may not be the case. For them, this company might be small. So that's why we are enforcing that deemed international be watchful on the global contracts. That is another area to pick to see whether the relationship is there and if that has to be disclosed. And naming the correct name, putting out the TIN number, tax identification number, all these things are prerequisite so that it doesn't appear that anywhere things are just casually being left out or just filling the box. Where do we get this list of details? We have just listed out the documents so that you are able to cross-reference and cross-check, and from a completeness, these getting source of information from these filings, including the 10K filings, will report the number of Indian companies that are there. So we will be able to get good access and completeness of information. You can comfort yourself by accessing these sources.
Just 2 points on clause 10. One is business description of the associated enterprise. Most of the time it is not correct. So we only limit what is the transaction between the assessee and the associated enterprise, and that business description is mentioned in the clause 10, which is not right. Clause 10 business description has to be the real business description of the associated enterprise. And tax identification number and PAN of the A's. If you look at it, the act and the rule and the form 3CEB in the rules, there is no requirement of that. But when you come to the portal, the online form, there is a requirement. So nobody has an answer that it is mandatory, not mandatory. If you have it, we are going ahead and file it. If you don't have it, we also don't know an answer. Until now, after the PAN and TAN were introduced, none of the audit cycle has been completed. So nobody is aware of whether there will be any penalty of misreporting or anything. We are not aware about it. But so far, the provisions of the acts do not require this information.
So we will move into the individual clauses. We will kind of just read the clause for you to get a context, and then we move to the notes and the various particulars that we need to kind of tell or points to point out.
Yeah. So coming to the first clause, which is 11, very simple to remember. Anything and everything related to materials, purchase, assembly, manufacturing. So it is broken into 3 parts. 11A is raw material. 11B is finished goods or traded goods. Now we are done with raw material, we are done with finished goods, capital goods and traded goods. What is left? Capital goods. 11C is capital goods. So these 3 clauses, these 3 categories come under the clause 11. Now what is required to be disclosed? Purchase and sale both. Okay. Transfer, lease or use of any other intangible property, including transactions specified in explanation 1A below section 92B2. So it is very important, whenever you are picking up one clause, please go back to see that which explanation it relates to in section 92B. Okay. What are you required to report? The common ones are name and address of the associated enterprise with whom the international transaction has been entered into. So this is common for all the clauses. I will not repeat this. Business description of transaction, including unit of measurement and quantity. So description of transaction will be simple: purchase, sale, lease, transfer. But the question of quantity, most of the time it has been seen that it was simply mentioned that due to the voluminous transaction, identifying the quantity was not possible. But actually it should be an effort to identify the quantity, and if you are reporting it, then it has to be accurate in terms of all the other records that you are maintaining. Whether GST, ledgers, or wherever you are reporting or you are disclosing those quantitative information, it should be consistent. Clause number C talks about amount paid or payable, received or receivable. So if we are maintaining basis the accrual, so all the paid or payable will also get reported. And since this is also a clause which requires sale transaction as well, so amount received or receivable will be reported. One, as per books of accounts. Second, as per the ALP. ALP is arm's length price. Now please pay attention that this requirement of reporting as per ALP is not there in every clause. So sometimes when the question comes up, okay, I have to report this, what will be the ALP? Please go back and look at the form 3CB. Is there a requirement at all to report ALP? While there will be a requirement to report the method to determine the ALP, so it is important that you establish the ALP, but sometimes the reporting is not required of the ALP. The last one will be method used for determining the arm's length price. This is again the common clause for all the common information required for all the clauses. Now moving on to the relevant notes and the practicality under the clause 11. We have combined 11 A, B, C.
Yeah, I think as we went through the clause, we discussed some of Yeah. Now it's audible. Yeah. So we discussed about these points on the methodology and this is yeah, cool. Even this might is yeah. So there can be some instances where trying to get it right in the respective clause. So 11A is for raw material, B is for traded goods, C is capital goods. So what could happen, like raw material is procured, but then ultimately it is not used for production, but it is sold off to another enterprise as raw material itself, who will be under B or A. So how would you kind of define that? So without any value addition, bought and from where the stockyard it is being sold. So can we keep it in 11A? Should we or should we get it into B, because that seems to be the end product for the entity to whom you have sold without doing a value addition. There are instances which can so come in. So again, give it some thought, because reporting into the right clause also matters. It's not like somewhere we have reported. And especially have a track of the goods in transit, because from a value, goods in transit, the opening and the closing. Opening, perhaps you would have included it in the previous year, so reduce the opening and no kind of factor for the closing, and then kind of report the value. Reconcile these things with the stock register. Also see what is the value disclosed for any other authorities. So that's important from a quantity and value as well. Track the returns, net it off or show it separately if required, and show it within the, if you want to net off, show it within the same clause. So these things are there, and always look at what is being the customs valuation when it comes to imported material, imported finished goods, capital goods. So there is a customs valuation. There is an SPV if there is a recurring material flowing, whether there is any addition by the customs authority, because customs and TP for income tax are at loggerheads. So one wants to maximize here, the one wants to maximize at the source. So that's so better try and get consistency, or have one methodology accepted by the income tax officer if that is feasible. Especially customs valuation becomes very important in situations where you find that there is a lot of dependency on the imported material. The company is not fully kind of break even. It is having capacity and it is making losses because it's not able to sell as much. Then you can leverage on the customs valuation and see if that can be used as a defense. And where you are aggregating the transactions normally, and especially when it comes to capital goods, so a capital item, if a plant and machinery is procured at 100, you kind of aggregate and you only take the amortized amount in the operating expense and you go on a T&M. So it is not the entire value of the capital goods that you have tested. You report the methodology as T&M and you have only factored the amortized cost while looking at the margin. So just evaluate whether what is the customs valuation for the landed cost of the capital goods, whether that you should also draw leverage on, and give a note when you are using T&M on an aggregated basis. You can always give a note that this is looked at an aggregated level. So these are some of the notes where you think you need to adequately cover yourself, and factors to consider before you take the final call of signing off the CCEV.
So I have a question, a practical question on the last point which Pradeep mentioned. So all of you are aware of T&M, transactional net margin method. So there's a company which we are justifying using transactional net margin method. The net profit is the profit level indicator which you are justifying, saying that okay, so from this business I have arrived, let's say 10% profitability. My comparables are also arrived at 10% profitability. The capital goods is procured and you are saying the depreciation of that is included in the cost, and hence it is an arm's length, the one which he spoke about, the aggregation. Now a case where the capital goods recorded in the RPT schedule of financials and in the RPT ledger is 100. But out of this 100, 20 is goods in transit. Now how do I justify this? Can I still use T&M? Because the it is not capitalized, 20 is not capitalized, depreciation is not charged. So can I still go ahead and use T&M?
By making a appropriate adjustment, by removing that depreciation for the...
It is not capitalized, it's goods in transit. So 20 is not accounted in my books in the assets. It is accounted in my ledgers of the related party as a payable also. So how do we benchmark?
So the purchase is not complete.
The
Purchase is 100.
Yes.
80.
Capitalized amount is 80. 20 is goods in transit. I'm audible, right?
Yes.
For the recording. No, that's not, I think, working. That's not working. So basically, either you can use it as a TMNM and say it's a timing difference, and this will get depreciated the next year. Or you do not report that 20 this year, give a note that I will report it the next year. Or you use a other method like a valuation report, custom valuation to benchmark the report. So these small things, many times we just overlook. So maybe we have to be specific when it comes to the capital goods and especially the goods in transit. Because in purchases what happens, the goods in transit would have hit your P&L in purchases as well. But in capital goods it will not be. So these are the things just we want to highlight from the practical consideration. Moving on to the clause 12. Clause 12 is intangible. So we spoke about the tangible goods in 11C. Now it's about the intangible. And an intangible, again, what do you need to report? It's sale, transfer, lease, purchase. Again, the first point is common, name and address. Second is description of the intangible property and nature of transaction. It could be a brand license, it could be technology license, it could be purchase or sale of a software. Third is any other, again common, paid payable or received receivable, amount as per books. Here also you have to provide the ALP. And again, the last one is the method choose to determine the ALP. Now moving to the practical considerations.
So, just among the participants, how many are aware of the AMP issue in transfer pricing, advertisement, market promotion, bright line test? Have you heard of AMP? Lady says yes. So, especially this intangibles, again, it's evolving issue. So, it's what is put out as a value in the financial statements and updating as goodwill or software licenses, and with respect to payout for royalty, fees for technical service, defined taxes withheld, and all of that. I mean, just to kind of hold the thought there on taxes withheld, you report it on grossed up, okay, from a reporting, so that you are reporting a total transaction and not a netted transaction, so the value is complete. Okay, so that's just from a reporting of the value. But coming back to AMP, this was a case where there was this Indian company which was extensively kind of doing marketing, brand building, advertisement for its larger global operations, for the group. So indirectly, since they were spending on advertisement market promotion more than their competitors and others from a line item also, if you see expense, it was significantly way higher. So when it went to the transfer pricing officer for an assessment, it appeared that apart from their regular activity on manufacturing, trading, they were also carrying some service which was relating to brand development by incurring significant expenses and taking a tax break on that. But what is the upside that the entity gets in India? Nothing, because they are spending over and above than as when benchmarked with other companies. So this was something seen as contributing to the global brand. It is creation of intangible, and that is a separate service. There has to be a markup for that service, and it went on a tangential line, and where a lot of companies in consumer markets, in wherever brand and trading marketing intangibles were involved, were bucketed, and it became an issue as AMP issue for transfer pricing. And it is still before the Supreme Court awaiting closure on the matter, because if you see fundamentally it is not an international transaction. For my advertisement market promotion, I have entered with third parties, event managers, various line items which are all domestic, expenses incurred here. So what got created is, by incurring all these expenses, I have got a competitive edge in the market. I have created so much, because you see on the front page there are advertisements, they are sponsoring various sports events. So you name, they are there everywhere from a recall. it's created so much, and that has not benefited because they have been sponsors of some of the global events. It's not benefited only in India, it is also benefited in markets elsewhere. So this has become a big issue. While on the fundamental principle or fundamental aspect of is there an international transaction as what is the expense incurred towards? At that level, the tribunals have come up saying that there is no international transaction in the first place, and as far as the profitability is concerned, if the company is making healthy profits, then let this be a service. Anyway, they are making more margins than their comparables, so that is also bundled and compensated. But for companies which are low margins, which are incurring loss, and especially which are only building brand for the group for capturing the larger market, especially on the e-commerce and consumer market side, this happens. So would we go and say there is an intangible creation, and would we voluntarily go and hold out something where there is no value because they just determined the revenue at the time of scrutiny, they just did a comparison. Like in automotive also this issue was there for whether it was Ford, Toyota, various companies this had this issue. They took some comparables, Indian comparables, like those times, like Hindustan Motors, they never spend. Or anyone whose regional player is already strong, they don't spend on EMP. The ones who have come in, you spend. So they determine the difference and determine that as excessive expense, and they said intangible got treated. So on that, what position will we take? Will we give a note on it, assuming that this is going to land up in litigation, or are we inviting undue attention? So when it comes to intangible, some of these are in black and white, which can be held out, and you can reconcile with all the numbers with your mistakes and all of that, and ensure numbers tally. But there are some intangibles, hard to value intangibles, where there is no value in the books, but from a disclosure, should we put a note that the company also does this and leave that note? How do we deal with it? So this is still something unanswered, but it is evolving. We can go to next.
Just to clause 12, again emphasizing on the requirement of intercompany agreement. The common transactions you might see royalty or fee for technical services. So in those cases, it is generally all these transactions will have an intercompany agreement, because when they are remitting money back from India, the RBI, the AD Bank will also ask for the agreement. So it is important that when you calculate the value to be reported as per books as well as per ARP, please look at the agreements as well, that the computation what is mentioned in the agreement is actually the way the assessee has calculated the royalty payments or FTS payments. Any questions?
Are we going fine, or is it too drag, or
It's fine.
One question. TP study report and benchmarking, whether two should be treated separate, or TP study report includes benchmarking. So should I get the TP study report every year? Is there any specification?
good question. You should be ideally sitting on the client side.
No, they ask this such question.
So very valid question. That's what it's so familiar. So see, how we go about is whether what has changed in the company from a function asset risk analysis, R analysis, and from an economic characterization of the business. Are they continuing in the manufacturing? Are they paying kind of royalty? Are they licensed manufacturer? If the business kind of has just expanded by top line with some additional customers and all of that, fundamental nature has not changed. Entire rest of the report can remain. The benchmarking has to be done revised because it's a new fiscal year for comparables and for ourselves. So what we suggest, and ideally some of the companies do, is they look at the report in totality once in 3 years or once in 2 years. But in today's environment, each one wants to expand and start off a small limb of new kind of operation, but then it kind of matures by the second year or third year. So it requires a total revisit. But otherwise, you can just have a benchmarking, refresh what we call, and stay on that. Because you can leverage the same as previous.
But that doesn't mean that you will not ask the SSC to prepare the TP report and keep it.
No,
For you to rely upon it is fine.
can that be an addendum to the TP study report, or should every year the same FIR analysis, the same
That's what requires.
documentation that
What Pradeep mentioned was going to give you comfort
asking. I'm saying clients ask such questions, so how to answer?
So that's what. So
whether Rule 20 requires every year to obtain a
yeah,
TP
it
study
is.
report.
It is to be maintained every year as a TP report because you can't give to the TPO only the benchmarking update. You have to give it as a full report with all the Rule 20 sub requirements of the documentation.
Yeah.
Okay, that has to be complete. Industry report has to be of the current financial year. We can't just use the industry report of the previous year. You can make some tweaks. I was telling you from a practical assistance and a solution for a client. But then the law requires every year to keep it
Afresh.
contemporaneous. When they say contemporaneous, for that year it has to be specific to that year. Okay, so what we can at the most leverage is the FAR, function assess risk analysis, specific to that company that has not changed, only headcount has changed, some people have come and gone, okay. That the company only can give us.
Operationally, it does not change, only numbers has
Changed, correct. Correct. So nothing fundamentally changes as far as that individual company or client goes. Industry changes, industry perspective has to be brought in, so that at least you will do an update. Benchmarking analysis anyway, you will have to do an update.
But Rule 10D doesn't tell 1 year, 3 years. So logically, judgmentally, it should be taken every year.
Yes, it has to be taken every year.
But the section does say contemporaneous document.
Yeah,
That
that's
is what presented. Contemporaneous is as and when the transaction is happening.
Similar transaction also. Same and similar.
so contemporaneous means before actually as you close the books, how it works is when you close the books, you will do a test check of are you meeting the margin or not. You would have some comparables would have got updated in the database for the current fiscal year data plus the last 2 year data. If you see, some of them are like say 12%, 13%, they have to come up to 15%. You take that call before you close the books, whether you should do it true up or are you okay. Okay, that's the time you will do this economic analysis ideally. But since database are not updated, we take it up to the return filing time. Okay, so from a planning perspective, it has to be done before book closure. From a compliance, it has to be done before the return filing with that cutoff, whatever is available. And that's how you go.
Okay, moving on to clause 13, favorite of Bangalore, because we are IT hub, so we see a lot of service entities where Indian entity is rendering a service to overseas entity, being a group entity or a related party, or AEs in terms of transfer pricing. So let's pay a little bit more attention on this. This, as I mentioned, is related to services. Pretty simple requirement: provided services, rendered services, or you have received the services. Again, the common information about the name and address of the assessee and description of the services. Now, IT service, ITES service, or management support service, administrative service, whatever kind of services, whether you have received or you have rendered, that needs to be mentioned over here. Similar to other clauses, paid payable amount or received receivable amounts, again as per the books and what is required as per the ALP. And as the books, again I would like to emphasize on the point of intercompany agreement or the transfer pricing policy. Generally, you might find two types of, in Bangalore at least, companies following TP policy, either hourly rate or man days rate or cost plus policy, where for example the entity is compensated on a cost plus 10%, 15%, whatever number. So if there is a written policy in the agreement, please verify whether as per the books of accounts that is maintained or not. If there is no written policy in the agreement, definitely company will have some internal email or communication with the overseas entity mentioning that this is a TP policy we follow in practice. So you can pay attention on that. And the last is the, again, method.
Yeah, so one thing heads up here is don't kind of tie up yourself into one particular service, because we see companies all the time doing mix of some services, IT, ITS, some R&D, some this. You leave it as service income open. You see how things are for the year and then kind of, because from a benchmarking side, IT will have a different benchmark, R&D will have a higher, ATO will be higher, ITS will be lower, MSS will be lowest. But if you tie up yourself by putting out very specific as to what it is, calling it out, then the officer will say you yourself have said R&D. Every other case, second case, third case, the intercompany agreement will say R&D, research and development. The overseas company takes pride in saying they have an R&D center here. Unfortunately, it is evolving at very nascent stage of development or very preliminary R&D. but they are hamstrung because of the agreement. Your agreement only says R&D, it is a different set of comparables, only high margin comparables. It's not software development set, you are honestly penalized to 28%. We have to be little smart, little sharp, share experiences and maneuver this by leaving few things which are, I would say, not disclosed. You just leave it little open, and generally auditors in financial statements have seen service income. Nothing else obvious ITS is more from the intercompany agreement, TP report. So 3CB don't volunteer to kind of go and categorize into one particular and fall in that bucket, because then in the transfer pricing assessment it becomes little landslide. Again, this is within the room and not hold me for that.
Just to the observation on clause 30 specifically, lot of times CAs get confused between cost plus method followed by the company as a TP policy. With the cost plus method mentioned in the section, the section of cost plus method is for manufacturing clients largely. It doesn't say cost plus of the same. When you're using cost plus, it's actually T&M. Because there, when you say cost plus as a PP policy, that means ultimately the profitability is what you are justifying. Whether you use the profit level indicator as profit over cost or profit over revenue. But that is not similar as cost plus method of the section. This is a very common point which we notice. Okay, now let's revise our accounting learning a little bit. Unearned and unbilled revenue. When it comes to services entities, have you analyzed, especially to the CAs who are signing the 3CBs, have you analyzed the unbilled and unearned revenue? Are we all clear conceptually?
And
That was the question we were supposed to ask you that question that we gave you.
When it comes to accounting, I'm always dependent on practicing chartered accountants. They are the best.
I mean, with respect to the concept of unbilled and unearned in the TP.
Okay, so it's very simple. Okay, as I mentioned, let us take a very simple example of a company rendering IT development services. Okay, the cost plus method is the TP policy. The agreement says that you will be invoicing every month or every quarter, for example. Now monthly invoicing is happening. How is it happening? Whatever cost is getting accounted, do a markup of 10%, 15%, do the invoice. Okay. At the end of the year, we as a CAs come as a duty to do all audit entries, and the number of expenses and the amount of operating expense will completely change. Right? So it could happen that when you did 12 months billing, at the end you had 100 as an operating expense, 15 as a markup, so you did 115 as a total year-end invoice. So far we are clear? But when we close the financial statement, it became actually 200. The operating expense was 200. How much we should have done the billing?
30.
230. What did we do?
150.
What is this? Unbilled or unearned?
unbilled.
So your sales will get recorded as
Unbilled.
230, including unbilled. Unbilled will sit in an asset. Your related party ledger will also get hit with 230, right? Because you will debit your party. So this 250, 230, what will happen? The invoice did not get raised during the year, but your related party ledger has hit, your P&L sales has hit, and because you are justifying using the profitability as a method, this revenue is actually pertaining to this current year only. So should you report it in this year or next year of invoicing?
Next year. In the current year.
Current year. So report it in current year. If there is no recommendation or there is no position, it's a comfort of a chartered accountant, you can take the decision. But if you give this is the amount invoiced during the year and this is the amount unbilled during the year, the total should tally to your RBT ledger or your sales account.
Sometimes unbilled is not hit to a related party ledger, rather a separate ledger is open.
Yeah, in that case, what you can take a call because your sales is hit, right? If you are using the profitability to justify during the year, you have to take that sales, and if that unbilled you report it next year, how will you justify that? Because that has not come to your P&L, right? So mention amount billed during the year, amount unbilled during the year, and the next year when you report it, the invoicing would have happened of this unbilled in the month of April or May, but you will not report it. One, because there is no hit to the RPT ledger also. In your case, there will be a hit to the RPT ledger, but you will give a note. It's better to disclose that this particular ledger this particular amount, what you have reported as amount as per books of account, does not include the unbilled of the prior year, which was reported in the prior year. Exact opposite, unearned. When invoicing was happening, it was 200 operating cost and you billed 230. When actual audit happened, the financial statement when you were closing, it was 100. How much you were supposed to do the billing for the year?
150.
150. How much you billed?
230.
What is it? Difference is?
Unearned.
So the unearned revenue is something that you have not earned during the year. So it will not hit your sales account also,
Yes.
but it will hit your your ledgers. I mean,
Like-
your will be what ledgers here.
Yeah.
So if you are using the profitability as a method, you can put a note that the unearned amount has not been reported this year, and you can report it in the year when you are actually taking it to sales. See, what happens is some of these questions do not have a particular answer. Okay, so you have to actually tie the dots. And whatever position you are taking, disclose it. So that if you are reporting it this year or next year, reporting is not anywhere missed out. So if there is a confusion that which year you need to be reported, take a call, but please put a disclosure.
See, it happens other way. In case of unearned, your related party is already hit because you've already billed. So it's the transaction to repay. In case of unbilled, you have an option not to hit the related party. So in case of unearned, it should be in the year of the transaction.
You can do that as well, but then again you will have to provide a note to justify the transaction in the next year. Because you are using the profitability. If you are not using the profitability as a method and you are using any other method, you can disclose the unearned revenue this year as well. So as I mentioned, the reporting can happen in both the years. And sometimes actually, I'm not sure, most of the cases what we have seen is unearned is actually booked to a liability and not hit the money ledger. So it could be the case.
Right, unearned is not hit, but the billing would have already
Will have already happened.
Point is being consistent about it, so that it kind of takes care for itself and follow that.
Okay, moving on to 14. So 14, 15 and 16. These three clauses are related to the financial transactions. Okay. Now 14 talks about anything and everything related to lending, borrowing, non-convertible preference shares. These are not convertible. Convertible will get reported in clause 16. Non-convertible preference shares or non-convertible debentures. It should logical because these are liabilities in nature, or any debt arising during the course of business. What do you need to report? Say name and address, nature of financing agreement. Financing agreement again, whether these are CCDs or they are non-convertible debentures, non-convertible preference shares, or a loan, ECDs, anything. Currency in which the transaction is taken place, USD, JPY, INR. What is the interest rate charged or paid? So it is 6%, 4%, 6% plus LIBOR. Amount paid or received, paid payable. This is again common. We'll come to you that what this amount paid is, whether it's an interest payment or the loan amount. What do you need to report here? Interest payment or the loan amount?
Both will
Both has to be reported.
interest.
If you have the presentations, do not flip to the next page, then we'll take answer. Okay, what are your thoughts? We'll come to that. Again, the method used for determining the ALP. I have a question on interest rate. So, the agreement says 6 months LIBOR, USD LIBOR plus 300 basis points. LIBOR will fluctuate every year. What will you report here? Effective interest rate during the year or 6 months LIBOR plus 300 basis points?
Effective interest rate.
Yes, but if you want, you can report both this.
Yeah, it can.
Because the actual policy is that.
It's not what will I report.
Yes.
The other one is okay.
Yeah. So financing transactions are something which in favorite for the transfer pricing officer. and we have seen instances where debt getting recharacterized as equity and the interest completely disallowed. So again, the documents, the underlying agreements, and all of this becomes very important. The benchmarking exercise that you do is of equal importance. So that's where pretty much, I mean, the LIBOR. So in case of a foreign currency loan, what comes in, it's you go with the LIBOR. But now all of you may be aware this LIBOR is now done with it. It's not last December, it's lost its relevance from then on. So now it's moved into a overnight interbank rate and SOFR and then SONIA for sterling and all of that. So for your companies where you are doing the transfer pricing advice, you please get them to benchmark it with the SONIA, SOFR and what is relevant in that geography from where the loan is coming. So LIBOR is gone by, so that's some opportunity that you can look at and also streamline and get that regularized. And this RBI Master Circular, all-in cost ceiling, ECB rates that used to be kind of there, that is not accepted as arm's length in any of the audits. They place reliance on safe harbor, but the rates are high, and again that's more kind of outbound than inbound. So this is one area which requires closer attention. And anything you should add there? Accounts receivable, you pick it up.
Before we move, we are just left 15 minutes, so till what time we can stretch?
I mean, if the participants are fine, we can start.
Perhaps it may not take beyond 10 minutes, perhaps from the scheduled time.
10-15 minutes, is that okay?
Yeah, yes.
Okay. So one of the requirements which is there in financing transaction, and also when we were talking about clause 13, services transactions, right? So if you read this clause 14, it says, in respect of lending, let me just go to the previous slide. Previous. Yes. In respect of lending, borrowing money, including any type of advance, payments, deferred payments, receivables. Okay. Now during the year there is a sales transactions. Going back to my 100 and 115 example, you raised invoice of 115, and obviously at the end of the year you will have a closing balance of receivables, right? Are you supposed to report it? Not report it. Why?
Consequential to sale unless.
But the
it results
clause
in-
says receivable.
Class says, but I have already reported. If it's an extension of the sale. Once I have set the sale and I have fixed it as TNM being the margin, there is no consequential transaction again. Then I will do a double reporting.
Okay.
Unless there is something which can stretch the logic to an implied bound. Say there is a overdue receivable or overdue payable, which can fall in any of these brackets. Otherwise, as long as the main transaction is reported, this will result in double reporting.
So in a case where they have just received the advance, the work is in progress, they are yet to raise the invoice. Would you report that?
No, receivable is one, sir. Yes, advance, yes.
Advance against exports.
Yes,
right?
advance against export is a separate transaction.
So you would show that.
Yes.
Irrespective of.
Yes.
But why? The
receivable-
same logic, right? You will receive advance, but you will raise the invoice and it will get set off.
Yes, correct, but that is a liability. That, there is no double reporting. The happening of the service, I don't know. Again, April, whatever may happen in the advance
But
may.
if there is a split between the year, so this year they have received the advance, next year kind of this revenue is to be recognized and kind of get squared out. So would you not report?
Sir, okay, let's go like this. Then what happens is the ledger analysis becomes important. So if it is a case where the AE is always on advance, funding the operations 3 months, you are in one of the scenarios, practically, with whatever domain we have seen. You are either always, you have an AE who's paying you, or you have an AE who's paying you behind. So based on that, one leg I would report, the other leg I would not report. So if it is advance consequent to sale, preceding a sale, then advance need not get reported if the consequential sale has come. Sale resulting in a receivable, which I have yet to.
What is the permitted credit cycle? Would it not be like, see, they are extending, so so it's a long run, then there is an element of cost attached to that.
Yes. So there I would say 180 days.
Any logic why the Act wants you to get this receivable reported? And just going back to that, where I was mentioning that amount paid, payable, received, receivable, what should be reported? So someone mentioned principal amount, someone mentioned rate amount.
The rate of interest, there we charge the interest rate charge, there the rate comes in.
Amount
Whereas the-
column?
Pardon me?
Amount column?
Amount paid or received, this is pertaining to the liability received.
No, so amount will have the interest element or the principal element.
Here it is the loan amount.
Then where will you report the interest amount?
Interest rate charged,
Amount of interest. That
not necessary, it is implied.
okay, but chapter 10 talks about income and expense.
Correct,
Hit to P&L.
correct. But
Loan
even
is not
reporting
hitting
shares
your
and
P&L.
reporting shares,
Correct. We'll come to
chapter
that.
10 is we leave it out.
Then no, we are reporting shares, right?
Yes.
But why will you not report interest?
I'll give it in the side, the last.
But that's the impact on the P&L, right?
Correct, but the question.
But how do you read it that it is amount paid,
It is
payable,
the
received,
arm's
received?
length for principal. The follow through on that is book of accounts, as per books of accounts, and then arm's
It's a
length
go back to
while
basic. Has the assessee entered into an international transaction in respect of lending or borrowing of money, including any type of advance payments, deferred payment receivable. So, the sum is yes, lending or borrowing. Right, what they are capturing is here, irrespective of chapter 10 or whatever, they are trying to capture the balance sheet. Lending or borrowing. Then comes subset to receivable, not receivable. Now what is, first is name and assessee, that is clear. Nature of agreement, it could be ECB, short-term loan, whatnot. Currency is any currency. What is the interest rate charged, paid? Here, rate charged / paid.
right.
Right, so I give my average rate. Now what is the amount paid, payable, received, receivable in the transaction as per books of accounts, as per, okay, since they are saying having regard to arm's length price, yes.
Interest
So-
amount.
Yes. So
Interest
here,
amount.
so actually speaking,
Yeah.
there is no clear answer.
Yes.
If you go back to the guidance note and also the practical experiences, you have to report the interest amount because that is what they are asking here, and you have to remind the ANP. But you have to disclose the payment amount, the principal borrowing and the repayment also. Now the question
That
is,
happened during the year.
yes, now the question is whether you disclose this as a note or you provide it as a report. And I mean, you give it here as 2 line items. One you say principal amount, repayment amount or interest. So you have an option to add line items,
Yes, one
right?
is line, I think the
Yeah.
last column is also.
So there is no yes and no answer to it.
Yeah, the last column also we generally remarks,
Right, exactly. So
We
there
try
is
to
no
attribute the other amount into
Yes.
the last remarks
So
column.
there is no yes and no, depending on the quantum of the transaction, the capacity of the taxpayer to bear the penalty consequences, and your own experiences. You have to decide whether you want to report the payment transaction borrowing principal or you disclose it. Now, repayment becomes easy because if you have reported the principal borrowed amount, then repayment is again double reporting. So that can easily go in the disclosures. But reporting of the principal borrowed becomes an important point. Now, coming just quickly, I will touch upon this receivable part because that has become one of the favorite topics of the revenue authorities these days. Why is this receivable payable is relevant? Why are they interested in knowing it? Okay. Have you all heard about interest on delayed receivables? Why is it important? What's the
Because it's an implied loan. That is the revenues content.
okay.
One, late realization of foreign exchange.
Any thought how working capital could impact your profitability?
Yeah, it definitely.
Okay. So let's take a simple example. This is a water bottle which I said. Madam comes to me saying that I want this water bottle. I said my price is 10. She said I'll give you advance right away. But I'll not pay you at 10. I said okay fine, take it at 8. Because she's giving me money from the person who I have procured it, I need not pay that person. I have to pay that person. I need not borrow from someone to manage my working capital. But you come to me and say that I want this bottle but I'll give you after payment after 60 days. Will I give it to you at 10 rupees? No.
Give it a
Right?
understand.
My price will get increased to include the cost of the working capital. Okay? That is where now the revenue authorities are very interested in this when it comes to taking the price, whether the price at which you have transacted it is arm's length or not, or the profitability has arrived basis taking the cost of working capital or not. That is where the whole debate about this account receivable payable has come. So, as he mentioned rightly, the one view is that you disclose this transaction of receivables payables at the end of the year as a note. Okay? Disclosure is important. You have to disclose it in Form 3CB either as a note and also mention the same in the transfer pricing documentation. And make a note that why is this not getting reported, because whatever he mentioned saying that is a consequence of the main transaction. But in case you decide to report it, there are CAs, there are firms who take a position that law requires you to report it, so you should report it and not disclose it. In that case, here is one trick. Few of these CA firms have taken a position to report it, but when you mention the aggregate value of the transaction in the first part A, you don't include that amount. Okay, so remember I was telling that there's something which we'll discuss on class 14. So that is again a view, no recommendation, nothing in writing, no settled position. Coming to the interest on delayed receivables. So when you report account receivables and payables, you will have to also analyze, is there a requirement of interest on delayed receivables? So is there a need of a slow motor adjustment to just the amount as per book says 0 but ALP has an amount? Bangalore Tribunal, all cases are so far unfavorable on this, that they have, I will say not so far, offered it. They have been saying that delayed interest on delayed receivables is an international transaction. So they determine the ALP. But there are case laws like Usum Healthcare of High Court where it was decided in favor of the SSC. Any question on this?
So, receivable word, shouldn't that be seen in the context of lending or borrowing of money? Receivable, if we literally interpret, it sounds like.
But lending and borrowing is already covered.
Just for a debate, we have to take that. I understand we have to take that. The context is lending or borrowing. Three keywords: lending, borrowing, money. My ordinary course of business has resulted in trade receivables. My intent of the SSC is not to do a finance transaction in that.
So the revenue takes a position as implied loan.
Yeah.
So if a normal credit days is, let's suppose 3 months, or if your intercompany agreement says 3 months, or your industry practice is 3 months, but you have given it the credit period of 1 year, 2 years. Is it a normal course of credit period?
Okay, where it's an abnormal course of transaction, then it will be deemed as receivable in this context.
In such cases, why can't it be taken under clause 19 rather than here?
Okay, very good question. When you're coming to clause 19, you wanted to cover that. See, you can do that, okay? Especially when you see the APAs. APAs have this clause of particular credit days you have to realize. If you're not realizing, there will be an interest implication. Those things are generally getting reported at 19. Okay, 19 is a residual clause. When something you cannot report it anywhere, you go to 19. This interest on delayed receivables, will it fit in 14?
See, I think when this capital financing got introduced and kind of had an expanded definition to have receivables and as much in the same footing as guarantee. On a guarantee, you may not have any implications. It might be just a line of credit analyzed and given. Out of that funding arrangement, even in fact, this company may stand to benefit by ensuring a continuous supply of material. But still, guarantee is interpreted as a financing arrangement. So, on the same breath, receivables up to 60 days is perhaps okay, but then it goes beyond. So, tied with the intercompany agreement, especially on services companies, see what the agreement says. Agreement will invariably say credit period for 60 days, some cases 90
So
days.
if it's lying with the credit period, that
One is
what
that.
receivable.
One is that. See when is the end customer realization happens at the group level. They take service from you. If it is services company, it is hand to mouth. Nobody keeps profit like a product company. So look at when is the realization for the group company with the customer. If that is 120, 180 based on milestone, you have some leverage. They will only receive or to pay me.
Okay, quickly covering the clause 15 in the same breath as just Pradeep mentioned about the guarantees. this talks about guarantees, and the first point is again common: name and address of the AE, nature of the guarantee agreement. It could be letter of comfort, it could be standby letter, it could be the corporate guarantee, any guarantee, whatever is the nature. Currency in which the guarantee transaction is taking place. Again, it is similar to the previous clause which we read of 14. Compensation fee charged paid in respect of the transaction. This is interesting, we'll talk about it, and again the method used for determining the ALP. Now, point to be noted, this clause does not require you to say amount as per the books and as per ALP. Okay, so this is one of those clauses where you need not report amount as per books and amount as per ALP.
So yeah, so we were discussing on guarantee, it may not cost them, and guarantee might be an initial convenience. I'm not using the line of credit, I'm just channelizing it so that my subsidiary somewhere in the middle of Africa is able to get some funding by channelizing my credit and my support, my banker, and is able to generate that raw material from there and ensure that there is uninterrupted supply to me. So it's a mutual convenience. It doesn't cost, it can get squared up. So how do you create economic and commercial reasons to justify that there is no charge required and there is a set-off that is happening? If I were not to have funded them, I would have need to go to an alternate vendor for the supply of material, and that would cost much more. So that is one way of looking at it. But pretty much now what we see in practice is 0.5 to 1.5 becomes a kind of a charge, which is like take or receive on a guarantee arrangement, which more by far companies are following that in place. But if it is more implicit or explicit, whether it costs or otherwise, it is more to support the past positions. But going forward, yes, there can be a consideration for that.
Here, small question. Practically, suppose my AE issues a guarantee to his banker. The banker in turn issues to a local bank. On the strength of that, I am borrowed. There is no charge. My AE is not charged. I am already in loss, so he is not charged. Is reporting required?
See, I think if that transaction involves a cost, some kind of a banker fee,
No charge.
there is no charge you are saying, there is no charge.
AE is
So,
totally a free
see,
service.
always there is a recourse available that the banker is extending this to the AE, and the AE has a larger exposure with the banker and ways to kind of compensate him on other arrangements, and that banker is extended to the my banker here. So effectively, see, when it comes to paying the
international transaction.
when it comes to paying the fee, it is a
Correct.
kind of an issue that can come in when it comes to if you do not receive by extending the guarantee, that is higher from a that you are missing out on some income which otherwise you should have received. So when we extend guarantee, that will be looked at more closely.
When I'm receiving.
When you are receiving, it should be a lesser issue unless they say that that could have been an income on which there would have been a TDS and that's a loss on that lines. But
But is it an
The
international
question,
transaction?
reporting is
Is it an international transaction?
It is. You report it as nil of amount pay or fee charged. Okay?
It's a
Because
figure.
it's in capitalization, it gets covered. So
No, there is no cost
There
here.
is no cost.
There is no
Okay.
interest here.
So here
There
is
is a
the-
local banker charges, I am paying interest.
Yes. There is no transaction. There is no value. That is called as free of cost corporate guarantees, right? Free of charge. But
I have not received the guarantee.
I said you have not
for
exercised.
guarantee you
No,
will not.
AE gives it to his banker.
So
The
the
banker
banker-
again gives it to a different bank here, whoever they have a tie-up with.
So that is what we call as implicit. By being part of the group, you are getting the benefit.
Correct,
Because that bank
definitely.
is
Yes.
So
See, if you are getting that loan, because suppose if that guarantee was not in
No,
place,
no,
no,
that
no, no.
definitely.
Are you getting the guarantee?
I am getting the money itself here.
You are getting the guarantee. See, anyways, when I go to the bank and say, give me loan, and say, Pradeep, give the guarantee, Pradeep will never give guarantee to me. He will give guarantee to the bank only, always, right? In your case also, the overseas entity is giving the guarantee on behalf of you to the bank,
Yes.
right? And that's why you are getting the loan. Is there a corporate guarantee?
No.
How? Charge is different. First level.
No, I am not a party to the guarantee. The guarantee is executed between say X bank and my
Correct.
There is no corporate guarantee.
Is that available to other AEs in other countries as well on the same footing as you get? Because you are part of
Here
that.
there are laws, so it is being extended. It's a special thing, that's it. Maybe other entities.
See, you will not be party to the guarantee, right? In a simple loan transaction, if someone goes to take the loan to the bank and say, bank will say, who's the guarantor, right? I reach out to someone. You have to be my guarantor. Now, guarantor will give guarantee to whom?
In my case, my AE's banker is giving a guarantee to my bank.
So that's a normal transaction of a guarantee, a corporate guarantee. Between them only always, right? But basis that guarantee, you are getting a loan. Correct? So, tomorrow if you default, will that corporate guarantee get revoked?
It will go through a law.
That is okay. Now it doesn't matter. Directly and indirectly, it will be, right?
It will get-
Is it a corporate guarantee? Received by you?
No.
Yes.
I am not signing.
Why not?
You will
I am
not
not
sign.
mentioned
So
as
you
a
are a
party.
beneficiary.
You are a beneficiary of a corporate guarantee, right?
No,
It's an implicit arrangement, and you are standing a beneficiary. And,
I am, yes, definitely I am the beneficiary.
Yeah, so
But I am not.
in fact, they would be right in charging you. If they are not charging you, it may not be as much an issue because you are not paying
Correct.
and it's not hitting your P&L.
Yes.
Practically, they are just
That's why I
saying,
report. I will say.
yeah, practically I am saying if you were to call this out, it could still be under the nature of guarantee, okay, at coming at nil.
We'll see.
Nil P, justifying the LP will be easy. You use other method and justify saying that first of all 92C3 will not allow you because if the TPO makes an adjustment to your income saying that you should have paid a guarantee fee, then under the reason that is not applicable, right? So strict interpretation of the clause, it is applicable. Want to take a call and do not report it and disclose it that I have got this guarantee, at least that much is required. So you have. Just one more important thing to identify the corporate guarantee. This will not be there in Article schedule. Yes. So we will have to take a specific confirmation or read the financial statement because generally wherever the long-term borrowings or short-term borrowings are there, working capital loan is there, there will be a note that this particular loan is backed by this particular guarantee. Same case with the standby letter and also letter of comfort. So just be careful. Okay, quickly moving to the share transaction, which is purchase and sale of equity and securities. As mentioned previously, that in the 14th clause it was non-convertible preferential, non-convertible debentures. Here it comes convertible debentures, convertible preference shares, and also the marketable securities and issue of equity shares. I think again the common things are name and address of the SSC, nature of transaction, whether it is preference shares, share, equity shares. Currency again is important. Consideration, charge or pay. So consideration charge in the sense, if you are issuing the shares to someone else, to your AE, you will charge a consideration. If there is a buyback of shares, you will pay the consideration. And again, this is important clause that it doesn't ask you to determine the ALP. Methods used for determining the ALP. So clause 16, I think all of you will be aware about the Vodafone decision and the circular post Vodafone. Do we have to touch upon that? So now post Vodafone discussion and the circular by finance minister, do we require to report the issuance of shares?
Only transfer of shares. Only transfer when
Not issue.
not issue, only on transfer. it will be reported.
Okay. So nowhere the law has changed to remove the issuance of shares from the definition of the international transaction. So even in case of Vodafone case, the transaction was reported, and one of the other cases was also there where transaction was not reported and court held that there will be a penal consequence. So the reporting is still required. If you read our guidance note also, that clearly says that ALP determination might not be needed, but reporting is still required.
See, what came as a release was the way the revenue went after is when kind of money comes in as capital infusion and there is a valuation involved and there is a premium part and there is a capital part. A different method of valuing based on discounted flows, and then they have visibility into forward years when they do assessment, and at that time there would have been some other projection that would have been taken. They would just change the valuation approach and jack it up 10 times and say that the differential is a premium which should have come, and it's not come, it's lying with them, so it's an income, and they would attribute interest also. So this was stretching it too far, decharacterizing it, and it's notional, and it's just simple play of numbers and nothing much. And but then there used to be huge liability. The differential valuation difference, the entire thing gets attributed to premium and income, and there is an interest to it. There was one case we got adjusted 15,000 crores because of this. So it reached unproportionate levels, and finally Bombay High Court decision was there in Vodafone saying that share premium can't take the color of income in the hands of the foreign investor, and the government also came up with that instruction saying that that kind of it didn't go against the High Court decision. So that's pretty much settled. But then there are some nuances: share capital, share application money. Is that a transaction? Because allotment only has not happened. It's share application money that is coming to the bank. Should it be reported? Because direct ownership also is not established because it is not allotted. And but then now with this stringency and because of these penal consequences, we would recommend that either even in situation where share application money through any other reason, if the relationship comes in, common directorship and other things, you please disclose it. Again, there is always a contradiction. If you are not filing the return, why should you file 3CB? This taxability, return filing, 3CB filing are on three different footing, and clearly don't relate the 3CB filing with taxation of income or filing of returns. 3CB has to be filed. Okay, so that's almost kind of getting settled even in case of foreign companies. So that's the better conservative approach to adopt. Yes, there could be repercussions, there could be foreign companies getting assessed because 3CB is filed, but not filing it doesn't put you on any better footing. We'll move quick in case because I am also mindful of the time.
We'll just touch upon only those practical aspects which we also see day in, day out. The only thing in clause 16(1) is first infusion of the shares, through which the A relationship is established. Reporting required, not required. Right?
Also, you are saying this is the A and you are showing the transaction with the A.
Okay, but this is the transaction through which the A relationship triggers. Should we report after the A transaction is established, or this transaction will also get reported?
This transaction also.
Majority? Reporting required? Okay, so there is no yes and no answer. You can interpret it. There are two views again on this. You can take a view of not reporting, saying that this is the first transaction through which the A relationship is getting triggered. So prior to this was not a related party transaction, so I am not reporting it. But just see if there is a memorandum. When the company is formed, there is a memorandum of they have to sign, right? There itself, if the OA's director or A has already signed, that means while the share infusion did not happen, the management was already there. The ownership was already established through that memorandum. So in that case, non-reporting might be slightly contradictory. Looking at the penal consequences and the quantum of the transaction, and if you want to be very aggressive, not reporting, or just disclosing, this is called. If you want to be conservative or just go by strict interpretation, you can still report it. Clause number 17, not very much seen in practical, very few limited cases. So what it says is, if you have entered into an international transaction with an associated enterprise or enterprises by way of a mutual agreement, arrangement for the allocation or apportionment of or any contribution to any cost or expense incurred or to be incurred in connection with a benefit, service, facility provided or to be provided. Lot of words, okay? Let's focus on mutual agreement, arrangement of allocation or attribution. For what? Connection with a benefit, service or facility provided. Example, there are a lot of group entities which avail some X kind of a services where it is decided that at a group level, one particular AE will carry out that, and every my group entity is getting the benefit of it. The cost, whatever is incurred by the AE, which will get apportioned or allocated using scientific method to all the AEs. So this and all the related parties have agreed to do this under a mutual agreement. So this clause will cover all those transactions. Again, same name and description, address of the SSE, A, description of the transaction, amount paid payable. Here you require to report as ALP as well. Amount as per books, amount as per ALP, and method to be determined.
I have a question here. Is it possible that in case of a group entity which does not have too many related parties, they have, let's say, only one related party in India, and there are some expenses being incurred by the foreign party, and as a consideration for that, they have reduced the cost plus margin here in India. Let's say if they would not have incurred that expense there, they would have, let's say, charged 18%, and just because they are incurring that expense there, they have discounted that to 15% or 14%.
We cover that in
See,
the cost?
I'll quickly address this. See, basically now the thing is there can't be a cost substitution. Okay, the Indian company has to input the right cost for delivery of its service. Okay, so they absorbing some cost and kind of netting it in markup is not permitted. Each international transaction should be standalone, be determined for its arm's length, for the service provided, extended, or the goods purchased, sold, whatever it is. So, where they are absorbing something or they are kind of facilitating something for which cost doesn't come into India is a no-no. The cost-based erosion is what everyone is figuring and targeting now, and that will come under the radar even if they get a small sense of that kind of an arrangement. So to be on the right side, let that come, let it build into the cost base and let that get charged with perhaps a lower markup. So are they charging or they are not charging because they are just bearing and they are saying that you reduce the markup? Is that what that's happening?
Yeah.
So which should not be the case. Let them bear, let them charge the cost, but let the markup perhaps be the same. That at least is defendable with the range and this thing we can try to defend, but let the cost come in whatever has been incurred, because that benefit has a value. That cost has to be attributed. That is how now we will, I think she will say kind of well on that later, especially on the ESOP cost. So that we will discuss in detail, which will address some bit and give more clarity on this point.
Clause 18 should be deal in detail, or if there is any question we can take it. It basically talks about the business restructuring. So business restructuring is not defined here. So you go back to guidance note and also you go back to the OECD definition. So maybe we can just talk about what is the
See, business restructuring, it involves reorganization of function, assess risk of an entity. An entity might be put out here for manufacturing based on the technology, which they have been kind of providing. But when it comes to realignment of functions, because these groups are large, for economies of scale and conveniences, they can move certain functions or move certain people. So when there is a change in function assets risk, cross-border redeployment of function assets risk, like the customer, because of some banking regulations, they want the service team to be in that country, and then India is cut off of that particular contract because of this thing, then that function only is not carried out here. It could be business reason, it could be regulatory reason, it could be some strategic reasons. If there is a redeployment, there is an angle of business restructuring, fundamentally from a transfer pricing. And also if there is an organizational change, ownership change, all of that will partake the color of business reorganization or restructuring, and that will involve, see, an income stream is getting cut. So if you redeploy, you will be like an entrepreneur, but if you are converted into a licensed manufacturer or a contract manufacturer, the returns reduce. So there has to be a compensation for that. When in a business restructuring arrangement, the entity which stands to lose is losing an income stream because of the remodeled way, and there has to be an exit charge. So all these are issues which, so when you report a business reorganization, as what Sudha detailed, is very simple. They want to know the nature of transaction, agreement relating to it. But what comes after that, if there is a redeployment of function assets risk, it will be a whole detailed exercise which the revenue will audit to see what you gained, what you lost. Whether the group gained, and if India has lost, then there has to be a compensation as a kind of a one-time compensation for scaling down of the operations. So that is what it is by and large, but it covers even the ownership structure change and all of that.
Okay, quickly moving to the clause 19, which is the residual clause. whatever doesn't get fit in 1 to 18, 11 to 18. But don't make this as a, choice of convenience. Okay? So that was the question I interest on labor, right? So sometimes what happens that out of convenience, everything is reported in 19. So let's not do that. What it says is any other transaction, okay, any other international transaction, including a transaction having a bearing on the profit, income, losses, asset, but not specifically referred to above. Above means 11 to 18. It's not covered there, you cover here. Now what could be the transactions? Simple reimbursements of expenses incurred by an entity on behalf of A. A incurred something on behalf of you, which you reimburse them. You're recovering something, those kind of transactions. Now here comes two beautiful transactions which are now favorite of revenue authorities as well. One is free of cost services, and the second is basic concept of free of cost services but applicable on share-based compensation. So free of cost transactions, what are these? As you mentioned in your example, the AE was providing a service, right? Let's take an example of Microsoft license. In most of the cases of MNCs, you will see that the laptop what the Indian employees are using, that might be procured in India. The Microsoft license will, or the payroll license or SAP license, Oracle license, that will be actually procured globally at a central level. Okay? That cost, most of the time, does not get cost charged to India. Okay? Now, transfer pricing is about what? What you would have done in a third party scenario. If your rate was not there, you would have paid for it. Right? So is it a free of cost service?
Yes.
Right? Should it come to your cost in your books? As an SSC, you will say no. As a CA, you are saying yes. As a revenue authority, it will say yes. So what is happening is because of these global arrangements, where sometimes what happens if an AE has a entities in 50 countries, and if you buy 5,000, 6,000 licenses, they will buy it work at a negotiated price, or they might have you want to have a centralized control. But in India, if you go and buy some 15 licenses, you will not get this cost. So these are sometimes some type of a free of cost services. Now what is happening is, of late in the scrutiny, this is getting picked up, and there is a free of cost service, right? The transaction has never happened. Will you report it? You cannot report it. There is no transaction. Most of the time, your SSC will not even know there is free of cost asset. They will not even know what is the quantum, even if they know that there is something. It's very difficult to get it, and we are talking about big MNCs. If you go to mid-sized companies, you will not even know. So the point is, if you know, if you're aware of it, ideal will be to at least disclose in the Form 3CD as a note. The company has received X amount of free of cost assets. And if you're not disclosing that, then maybe you should have a good rationale about why you're not disclosing. The debate is still on. This is not a settled position, and this issue is now up before the Bangalore Tribunal. So we'll have to see how it comes, specifically in case of the service entities. Moving on to the share-based compensation. So all of you are aware about RSUs, ESOP and ESPP, right? Share-based compensation is nothing but where the shares type share-related compensation, which is employee stock options or employee share purchase plan or RSU, restricted stock units, are given by the parent entity of the Indian company. Let's say parent entity P is F company and Indian entity is I company. F company gives the share-based compensation to the employee of I company. Is that clear?
Yeah.
Okay. Now what happens is, so far the guidance note of AS15 was just a guidance note, right? So it was not asking you to mandatorily record this cost in your books. In your books in the sense the cost of the Indian company. Now what is the cost I am referring to? In case of ESOP, what happens? Let's say the company will say that you be here in work with Indian company, I will give you share-based compensation as you will have the right to buy my shares after let's say 3 years or after completing 5 years. These are called vesting periods. Okay? So you get an employee will get motivated to continue in the firm. Most of the time these ESOPs are either given free of cost or at a discounted value. Now the discount which the company is bearing, which the F company is bearing, isn't it a cost to the company? Correct? So what the revenue authorities and also in safe harbor notices included that if a share-based compensation related cost is incurred by the AE, in my example F company, that has to be ideally cross-charged to India or included in the cost of the I company at the time of arriving at profitability. Okay? Now, how do you find out where there's nothing, where there's a cost or not? So as I mentioned, ICA guideline, the guidance note AS15 was so far not mandatory. So you will find a note in the balance sheet saying that there are stock-based compensation provided by the F company, but because I company is not managing it, not administrating it, we are not required to charge or record any notional cost in my books. But from April 21 onwards, this has also changed. So AS15 has also been modified. So you might now see notional costs getting booked in your financial statements, and also in Indians, it is mandatory to book the notional cost. So what could be the transaction that we get reported? One, I spoke about that cost, which is in the F company. If that is getting cross-charged, that becomes one transaction. In case of employee share purchase plan, what happens? Employees are given options to contribute every month. Okay? So they will be contributing out of their salary. Intercompany will record 100 as a salary. Employee will say, you give me 85, 15, you give it as a ESPP contribution. That 15 has ultimately go back to F company. So that could be one of the transactions which is written as remittance toward employee stock purchase contribution. The third transaction will be recovery of taxes. Now what happens if the employee is getting a share free of cost? Is it kind of a perquisite? TDS is required, right? Suppose employee was supposed to get free of cost 100 shares. Amount is also 100. What F company will do, before allotting the shares to Indian entity, they will withhold that equivalent tax amount. So example, if 30 is the tax percentage, 30 shares will be withheld there. Employee will get only 70 shares. The 30 amount will be passed on to I company to pay the taxes to the government. But this becomes a related party transaction. So you will have to report that as a recovery of taxes. All these transactions give a proper note how you are justifying what is this plan all about and what is the cost associated to it, so that at the time of benchmarking and explaining before the revenue authorities, you are clear about each and every transaction. Any question or too much for today?
Even in this case, after the new guidance note has come, there are two methods of valuing the cost in the I company. One of those says that the difference at the time of issue itself between the valued price and the issue price. In some cases, that is zero.
Correct.
So in that case, nothing to be reported.
See, the point is, what you report in a financial statement might be different from what you report in Form 3C. Now, what you are saying is a notional cost that is getting reported in your financial statement,
Which is
right?
zero.
Which is zero.
Yeah.
But there is no, anyways, if suppose in your other method there was a cost that was to be reported, but there is no transaction with the related party.
Yeah.
So what will you report it?
Where?
You cannot report that transaction. The question will come from the perspective of, for example, in a cost plus company. This is a notional cost. Will you include it in arriving at the cost plus markup?
Yeah.
Right? It's a notional cost.
It's part of the financials, no?
That is okay.
Part of the P&L. If I am following TNMM and it is part of the indirect expenses, I will include it.
If it's not part, as you said, then it was zero.
If it is zero, then there is no question.
Okay, so you include it in cost plus in your example for today. 100 was your operating expense, 10 was your ESOP, 110 becomes your cost.
Yeah.
Okay, on that you apply a markup. Let's suppose total income comes to 135. You will take 135 to return of income. Will this notional cost get admissible expense in your return of income?
Yeah.
No.
At the time of exercise, based on the valuation report, we will get a deduction for it also, right?
Do you really get a deduction, or is it based on settlement? The notional cost.
Not the notional cost.
This is the notional cost what you are recording, right?
Notional cost.
F company has won the shares. F company has the actual cost. You are recording because of the accounting standard here as a notional cost. Will you ever get a deduction?
Yeah, we get a deduction for it.
When?
At the time of exercise.
So not in that year. So in your computation, you would kind of have it disallowed yourself.
Yeah.
And align your transfer pricing provision with the tax computation. Okay. So one recommendation is have it as non-operating for your TP margins, because you yourself have disallowed it in the tax computation. There can't be a double whammy, disallow it for tax computation and then have a markup after that in income. You get that? So, your question?
Yeah. In this scenario, let's say the But if you generally see, you use Blackstone model to value these shares. And in case of notional cost also, you use the same method which is being reported in their financial statement. In this case, how do you determine the price, arm's length price?
Arm's length price of?
Because books is a notional. Value in books is what you pick up from the book. And what happens to the arm's length price?
But why do you report this transaction? In your financial statement, there is a hit to the RPT.
There is no hit to the RPT, but there is a hit to the expense and corresponding
Capital reserve.
capital.
It's not a related party transaction.
Contribution.
It's not a related party transaction. So what we are trying to tell you, the three possible related party transactions in case of stock-based compensation is mentioned here. Okay. Now what you should be mindful is where there is no cross charge. The first one says reimbursement towards stock-based compensation cost. When the cost incurred by F company is cross charged to you, it is clear, right? Where it is not cross charged, there is what you have to pay attention.
That itself is a notional cost.
That
it's
is
not cost charge because that's why I'm taking a hit as a notional cost.
correct. So in that case, that now the authorities are getting into it that why this cross charge was not happened. To that extent, your cost is not recorded appropriately, right? And also, there is an impact in GST. If there is a free, I'm not a GST matter expert, but what I understand is if this is something as a free of cost, whether it's a service or ESOP, there is an impact of GST and also now impact in the Income Tax Act as well. When you get something as a free of cost, that might be considered as your deemed income. So your free of cost assets, your stock-based compensations, all are related to this concept of what you're getting as free. So in case there is a notional cost not getting cross charged, you're recording in your books. One, you have to be see whether you're how you're dealing it with your profitability. And second, if you are treating it as operating in your answer what you said you will include it, then what happens to the return of income? Ultimately, you will end up paying tax on the cost plus a markup. Otherwise, what happens? You pay tax on the markup portion, right? Because tax you claim as an admissible expense either this year or next year. But in this case, in the notional entry, you will actually not get a benefit in the ITR. Because it will never get on your actual cost because it is borne by the F company.
If I am not wrong, in the year of issue of ESOP, it is not allowed. But in the year of exercise,
But you are not issuing the shares. No, shares are issued by a company.
Exercise, they are saying you will claim and
You won't not be able to track that when they are, because it's a notional cost which is already there. And this is
that
not
Biocon judgment is there, right? Where
Correct.
they have allowed and they have said that it is not a notional cost.
That year you will claim. What about the years you have not been able to? But you pay taxes on that year, no? Every year's cost will be different, the markup amount will come different.
Yeah.
So how will you map it?
Map with what?
Map the PLI of that year with the year you are actually giving the expense. So maybe if you are able to do that, claim it and map it, you can continue to do that. But just the attention has to be paid, whether it should be included in cost or not. The safe harbor rules and the position of the transfer pricing officer field level is to take this as operating in the cost base, not settle position per se at the courts. There is a favorable case law Bangalore Tribunal which says that ESOP, if there is no cross charge, the notional cost cannot be taken as a transaction to be included in the cost base.
But again, the long point short is just to be watchful on this, how the transaction flows and be consistent with the position taken in the return and align it with transfer. Great.
And most of the time, the last 2 points of remittance and recovery will not be reported in RPT. Sometimes the balance sheet, this gets through balance sheet and this is not be reported in RPT statement. So you have to find that out.
I think you have completely ran out of time. Just being mindful.
And when we move to effective.
Yeah. I think deemed international we touched upon and I have explained. There can be a tripartite arrangement, there can be a quadrilateral. If there is a quadrilateral, we can rule out that it's a deeming provision. The facts have to be strictly interpreted to the facts of the case, the provisions. So in a quadrilateral, it won't come, it will fall out. That's the example. I think the material is shared with you. We'll just go to the FAQ, keep it light, and for those who have already, okay, this is a PDF question, so FAQ has the answers there.
And any question on the SPT part? Mostly in Bangalore,
again,
SEZ might be one thing you will have to be watchful. Anyways, now 22 onwards there is no new SEZ, but if some entity still left out of SEZ, then 10 AA you have to be just careful. And others also, by explicitly doesn't mention who has to report. The assessee who is claiming the eligible benefits or the other entity. But if you read the law, intent of the law, it says that the entity who is actually claiming the benefit should be reporting these transactions. 115 BAB, again the question is, it says if you believe there is an extraordinary profit, or profit more than ordinary business. Well, any SEC really go and say that there is a profit more than ordinary business. If anyone has seen in practical cases, please feel free to chip in.
See again the transfer pricing that you adopt for determining arm's length versus what is more than normal profit in a SDT kind of a situation would be different. The comparables can be different because as companies generally having talks, holiday units might be making higher margins possible, but again they may be captives with a cost plus kind of a thing. So they may be around the same. So SDT again the threshold is 20 crore. It's huge. It's wide still. So very few implications. 48 to be related party payments is not covered by transfer pricing officer but by the licensing officer. So keep some backup. And again from a corporate governance angle also transfer pricing is getting quite significant. So yes, I mean coming back to 3CB reporting certification, just be as cautious in terms of we as certifying accountants tomorrow for no fault of ours should land up in a challenge trying to defend any penalty or anything against us. So and have the management representation letter completely jotted transaction wise, whatever your assumptions clients kind of facts presented by them, get a clear sign off on the rep letter from the companies on various positions that are taken. So with this I think we have overshot, but I think we have been able to bring all the practical experiences. So we have to go back and we have about another 140 TCPs to go. So.
Any question on the FAQs? I just want to do it correctly, okay? So there is a difference between a RKT and a ledger of 9 rupees also, 3 rupees, 4 rupees. Ideal position reported as a ledger because it's true and correct. Any question on the FAQs?
It is already reviewed today.
Very clarification if needed.
I have a question. Now that we will be doing the benchmarking for 21-22, should we take 3 years now and do the benchmarking, or should we take only 2 years now and later, say 1 month or 2 months later, do for the entire 3 years?
It will take 3 years. There will be perhaps 30% that will be updated with numbers, but you get a trend. You at least see how it is being going up, down, and then so our recommendation is have a cutoff at the time when you just before file the
ITR.
Yeah, ITR you can go up to ITR. Have that as a backup. Anyway, at the time of assessment, the transfer pricing officer will go as on that date, and that flexibility you do have. So you can bring in, you can pull out. So you can always deal with it again the second time around at the time of scrutiny.
Okay.
So when you run the database, you
Not
can
to
take the
exclude.
database of this current year. Okay? Cutoff of the database has to be of the current year.
Yeah.
Okay? You will do the benchmarking taking as if you are doing for the 3 years.
Okay.
Okay? 3 years will be there. Third year will be NA because it is not available. Okay? If 30% is available, very good. If it is not available because a lot of finances are not included.
Yeah.
What do? You look at what's the result you are getting. Then go back to the previous year with all the 3 years number and do an evaluation. Is there really significant difference or deviation from the last year which you believe will get equalized if you have the third year data? Then you rely on the 3 years benchmarking using the current year, but also you can take and you will leverage on the previous year benchmarking as well, saying that because the current year data is not available, I am going back to the third year. Some people have also taken up the 4-year data. But leaving the current year and not taking it is not recommended as per the provision. Because provision says if for the current year some comparable is not comparable at all, you cannot take it for the 2 previous year also. So benchmarking has to be taken the cutoff of current.
come to an end
of excellent session. Of course, hope today's entire session was fruitful. And special thanks to Pradeep, who even in his busy schedule, as he was mentioning, he has to go back and file quite a lot of speeches left unfiled. So thank you for making your time. As a mark of gratitude and respect on behalf of Bangalore branch of SISC, I would like to present a token of appreciation.
So they are taking the photo.
Thank you once again. And members, thank you for making your time out and attending this today's seminar. Hope your knowledge kitty has improved further than what it was when you started the session today. Thank you everyone. Good night.